Happy 2021. I hope your new year is off to a great start. As a new administration takes office, it of course throws some uncertainty into the tax laws. Will they stay the same or will they change? We do know that the new administration has proposed changes to the tax code that, I'm the first to admit, throws some uncertainty into retirement planning. But rather than focusing on what's out of our control, congressional tax law changes, let's focus on what you can control, and that's moving your taxable retirement accounts into tax-free Roth IRAs. You'll pay tax on the conversion at today's low known tax rates, but then you won't care what future tax rules might be because you have assets not subject to those rules. Roth IRAs can be a great way to turn your retirement assets into future tax-free income. Since the money inside the Roth has already been taxed, you don't have to pay taxes on qualified withdrawals, and you don't have to take required minimum distributions. Importantly, that Roth IRA will pass to your heirs tax-free, which is even more valuable now under the Secure Act rules that we discussed last year. There's a lot of fine print that comes along with a conversion, and they're not right for everyone. And I generally don't suggest doing a large conversion all at once, but rather a systematic, multi-year strategy that manages that tax bite. So when could a Roth conversion be a good idea for you? Well, when you think you'll be in a higher tax bracket in retirement, whether because of higher income, the expectation of higher federal tax rates, or you're moving to a higher tax state. If your retirement account has lost value, converting a greater percentage of your account for the same tax dollars can make sense. And you generally want to have money outside of the account to pay the taxes. So when could conversion be a bad idea? Well, when you expect to be in a lower tax bracket in retirement, or you don't think tax rates are going to be higher in the future. If you're in a higher tax bracket now, you'll be paying taxes at a higher rate on the conversion than you would pay on the money coming out later. It could also be a bad idea if you don't have the cash on hand to pay the taxes that you're going to owe, or if you expect that you're going to need the money in that Roth sooner rather than later. Because if you withdraw earnings from your Roth IRA within 5 years of the conversion, you might owe penalties due to IRS rules. Bottom line, Roth conversions are a great retirement and tax planning tool, but the details and your personal situation matter a lot. And under current tax rules, conversions are permanent. No do-overs anymore. If you think a Roth conversion might be a good idea this year, then please use the form below to request a callback. I'll walk you through a process to help you decide if it's the right move in 2021 for you. In the meantime, stay safe and warm. Take care.